Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, it's a cloudy morning here in Vancouver and a little cloudy in the financial market.
We have several listener questions to wade through today. Our first question comes from Justin in Berkeley. Hi, over the years I've jotted down various key things to track when I read Charts and Markets or to hear Bob's podcast. It appears we have a trifecta of events that look pretty lousy. The dollar index is way up at 108, 109, and parity with the euro. That's something we haven't seen in 20 years.
Yeah.
Credit spreads widening despite the U.S. Treasury rates increasing as well. Gold-silver ratio jumped to 95. Is there a superfecta I'm missing? Foreign outlying markets like Sri Lanka are also cratering. Are Bob and Ross going to the betting window for the fall show?
Jason, your good summary of events. And you've described it. Hey, it's there. The excesses were in the S&P were made in December, January, and that's when we noted that often terrific market events can peak in January, and we cited gold and silver in 1980. Memory's right, I think it was January 21st. And then also there was the Nikkei that peaked on the last trading day of 1989. And then the one that was interesting was the S&P that peaked in January of 1973. And the worst bear market since the 1930s followed. It finally cleared in December of 1974. So, and then I have a friend of mine has got some pretty good chart history, Ron Grease over at the Chart Store, and he's running a analog overlay with the S&P now compared to 1973 since the first of the year, and you start one of those charts, both at 100. It's remarkably close. So, anyways, we've had a devastating first half, and then whatever sunshine would be around, like for commodities and stuff like that, would then become vulnerable after mid-year. And part of that vulnerability, as you mentioned, Jason, is the U.S. dollar being firm. And while it's been around 108, our target is now 120 in a period of financial distress. Typically, the senior currency in the world goes up in a post-bubble contraction, and this is happening. So, thanks for your outline, Jason.
Question from Michael. Hi, Jim and Bob. Many financial analysts say that inflation is sticky and prices for commodities and services have a tendency to stay somewhat elevated and tend to stabilize but not decrease even in a recession. Bob, assuming a deflationary recession, can equities, commodity prices, and the cost of services significantly decrease, possibly to levels last seen after the great financial crisis?
Yep. Michael, you're on. The markets are there's two kinds of inflation out there. The inflation in intangible assets like commodities and things that if you drop them and they fall on your toe, they hurt. That's an old one. And that was blossomed in the 1970s, and it was most distressful because the rate of consumer price inflation always goes up faster than wages do, and it is plain distressful, and I remember it at the time. And that was similar to the 19-teens when you went up and had that huge blow-off in commodities in 1920. So that is what most people, most academics, and most central bankers understand as inflation. But if you have a historical perspective, there is another kind of inflation, and that's inflation in financial assets, stocks and bonds. And this is where we've been for some considerable time. And to give you an idea just how extraordinary, well, let's call it hyperinflation in bonds until a while ago. But in Germany, their 10-year note got to something like minus 0.89% nominal. Never in the history of interest rates have they ever traded below or traded at a negative. Never. Yeah, adjusted for inflation, they can go negative, which happened earlier this year. So anyways, then the other one is that in crazy mining markets, you can have a penny stock go from pennies to, $20, $30, or $40, huge percentage gains. But in the crypto Bitcoin game, the market caps were huge and the percentage gains were off of any history. Huge, unbelievable. So then that is conclusive that the big game has been in financial assets. And when that bubble completes, then you go into a post-bubble contraction. And we'll just review some of the things like real copper price, which typically goes up with the bubble. It turns down, and it has really turned down. Other metal prices are weakening. But recently, this year, of course, you had not just the commodity prices going up with the final leg of a financial bubble. You also had extraordinary intrusions with the worldwide lockdown because of the COVID hysteria, which broke a lot of supply. And then more recently, you had Russia's invasion of Ukraine, which may or may not have bottled up a large grain supply. But we look at the prices, and commodities like the CRB got hugely overbought, the most since the cyclical peaks in 2011 and 2008. So that kind of technical excesses tells you that all the bulls are in. And then also we've been able to tie it to the completion of a financial bubble. So like real price of gold goes down in the bubble, gold stocks underperform, then the bubble's over and stocks get hit, which takes down the gold stocks. This is happening. The senior currency, which is the U.S. dollar, goes up, and that's happening. Real long interest rates turn from down to up, and that is happening. So I think we're well into a post-bubble contraction, and most asset prices will decline over a period of time, quite a period of time. Some of these post-bubble contractions have lasted for 20 years with the usual 3 or 4 year business cycle coming and going. So at various times there'll be bids for commodities on a brief economic expansion, and then there will be back to poor bids on the next recession. So that's the way financial history has worked. Now, was there another part of the question?
Yes, Michael also asked, the U.S. dollar seems unstoppable, but is very overbought. Bob, do you see a near to intermediate term decline in the U.S. dollar before it goes to new highs?
Well, maybe a sideways, modest correction for the next through August, perhaps. And then we get into the fall, which is the time when serious credit problems can be discovered. And the credit problems always follow a wild financial bubble. So, hey, it looks like the fall could be there could be another phase of liquidity problems, in which case hitherto bid-up assets get hit. So all of this is, it looks on schedule.
Our third bunch of questions comes from Andrew. First off, U.S. LIBOR rates have been rising almost every day in these recent weeks. Does this signify rising risk, as in 2008 when banks allegedly stopped lending to each other?
Yeah, Michael, sorry, that's from Andrew. Sorry. Yeah, short interest rates such as 3-month or 6-month Treasury bills rates go up during the boom. And the rise in interest rates over the last, in the 6-month rate has been remarkable, straight up and getting overbought. But when short rates are moving like this, you don't know how long they can stay overbought. But the real signal will come in is when the T-bill rate turns down. Now, I don't know when that's going to happen. But in 1929, the T-bill rate went up to June and then turned down. And that decline was signaling that various aspects of the bubble were over. And the Fed in that year, early in the year, there were those on the committee that were concerned about radical stock speculation and wanted to raise rates, the administered rate, to kind of cool the boom. But the overall committee wasn't having it. But for some reason or other, maybe some key guys were on holiday in August 1929, and then they raised their discount rate from 5 to 6%. So I've reviewed the difference between market rates of interest, such as T-bills, and administered rates of interest at the central banks. And at key times, whether at bottoms or tops, the move in market rates of interest, as recorded by the Treasury bill rate, leads the key moves by the central bank, by the big central bank, by 4 or 5 months. So here's our forecast now, that this could be the last Fed rate increase. Everybody's saying it's going to go on forever. And come October, late October, under financial market pressures, the Fed will then announce its cutting rates. So it's the same as they did in 1929. And not only that, we're going to add one here. Through the 1920s, following the bust in the big commodity boom in 1920, the Fed was very concerned about deflation. They had to keep inflation up. So the Fed was very easy in monetary policy and was injecting capital into what turned out to be a great financial bubble. They didn't understand financial bubbles then and didn't realize that adding fuel to the fire, that the bigger the boom, the harder the bust. So here we are. Over much of the last decade, the Fed has said, we got to keep inflation at 2%, otherwise we got deflation. So they were intentionally easy, not understanding that we were in yet again another great financial bubble. So they added fuel to the fire, and with not understanding the nature of a financial bubble. They haven't learned anything in 100 years, which is pathetic. So at any rate, I think that the contraction, when it becomes a little more severe, is going to be very instructive to a lot of central bankers and a lot of academics, and also to the public, because they will have seen in the States that the Federal Reserve literally spent trillions, and the taxpayers on the line for it. So they spent trillions of taxpayers' dollars in order to prevent bad things from happening. And then with a very bad thing happening, I think this time the Fed can be seriously condemned. What are we going to call it, Jim? Malpractice? Yeah, that's a good one. But thanks for the question.
Andrew's question actually continues here.
Oh, yeah.
One would think we already have discovered a liquidity crisis given the crypto companies blowing up recently. Is there more to come? And if so, what?
Oh, yeah. No, the cryptos, as I said on another question, became the biggest equity phenomenon in history. And it costs huge to make those bitcoins or cryptos, and it costs huge to maintain the package of them. And in a bear market, this is really self-contractionary. It's going to continue down to maybe somebody might come up with a useful bitcoin at some time. The most useful one would be a unit that has a constant purchasing power, and then it could become a worthwhile currency. But in the meantime, the Bitcoin side has been nothing more than a special counter to speculate with in a world of radical speculation. We're going to get a whole lot worse.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Some of the headlines that caught your eye today. The first one, U.S. industrial production unexpectedly tumbles in June.
Yep, that's an important economic number. And then on other economic numbers, the GDP calculation was, I think, minus 1.4 in the first quarter and minus a little over 2 in the second quarter. And one definition of a recession has been 2 quarters back-to-back of negative GDP growth. But at some point, the NBER, National Bureau of Economic Research, is the body that actually determines when the recession started or when it ended, and they often are a drag. It takes them quite a while before they say that the recession has started. But in my mind, it's worked out here whereby on previous great financial booms, the moment the stock market turns down, it takes the economy with it, and this is borne out in the first half of this year. Yeah.
Next headline, China property bonds plunge after an enormous downgrading for the property manager Vanke.
Yeah, what I read in that headline was that the chronic problem since June a year ago in China's lower grade bonds is now hitting an investment grade property developer. It's hitting their bonds. So that's what happens in post-bubble contractions. The lower grade stuff gets hit first, and then eventually the chronic loss of liquidity starts to pull down high grade bonds. And as I say, it's classic stuff.
Headline, damage could be huge as Chinese banks tumble due to mortgage non-payments, with home buyers refusing to continue mortgages on unfinished condos.
Yep. Isn't that a classic? Gosh, I saw a video just the other night, a video clip of a hugely tall building in Shanghai, only partly rented out, completed maybe 3 or 4 years ago, but only partly rented out. And then there are other residential complexes where there could be 10 apartment towers altogether, completely empty. It's astonishing, and also it reminds of after the 1873 bubble, which big infatuation was in railroad stocks, and everybody was building railroads from here to there and everywhere. And the great Vanderbilt observed that there really was, this was after the crash, there was really no need to build railroads from nowhere to nowhere. And so what you've got in China is huge towers empty. And so it's the equivalent of nowhere to nowhere. And also, they have been building highways and railroads that could be seen at some time as going from nowhere to nowhere. So it's going to be very interesting.
Well, I'm just looking at the article that goes along with the people refusing to pay their mortgages in China. In China, developers use mortgage payments to finance new property projects. So if there's no mortgage payments, the projects don't get completed. But doesn't that also smack of a Ponzi scheme using today's investor
to
pay off yesterday's?
But it sounds like they're taking current participants in and using their funds to pay off earlier participants, and that's the classic Ponzi.
Yeah.
And I think it was happening in the Bitcoin thing as well. For a Ponzi scheme, you have to have an exotic instrument, and the original Ponzi, way back in the early 1900s, it was based upon rates that I think that that deposits at post offices in Europe were paying, and this was, of course, a higher rate than in the United States, so he had this rigged up, and these guys are brilliant salespeople, and once they get going, they can't get off it, and of course they're siphoning off huge amounts of money for a grand lifestyle, and Bernie Madoff, that was a huge one, recent, and and the issue seems to work because in a new financial era, people will accept any story. It's just the urge to believe while something is going straight up, it becomes very, very strong. And, this is one line I used years ago in looking at wild Vancouver mining stocks, is that so long as the price is going up, participants will believe the most absurd or preposterous story, because the rising price confirms their belief system. And then when it cracks, it's all over, like the crack in Bitcoins. It is all over. So, and where you see in just the last 300 years of history, marvelous replications on each great financial bubble, and but the same thing happened way back. You had rampantly speculative markets in Rome 2,000 years ago. In the 1340s, in northern Italy was the financial center of the world then, and the main instrument for investing and trading was in mortgages. And then there was a massive crash in mortgages. And an Italian financial historian by the name of Cipolla wrote a very good book on it. And the one thing you get out of it was that the most severe parts of that disaster occurred in the fall. So what's facing us here after August? Oh, they call it fall, don't they? It'll be interesting.
Another headline, real retail sales shrink for second straight month.
Yeah, that's where they take the headline retail sales number and adjust it for inflation. So while the price of items is going up, the number of items being bought is declining. So real retail sales going down. I think that's one to watch.
Well, with inflation running rampant, food prices high, fuel prices high, rents going up, I think discretionary spending has nowhere to go but down. Do you really need to buy that third swimsuit?
Yep, you trim it all back. Now, I've been very concerned about exposure to COVID over the last 2 years and have hardly gone out. But recently, my daughter took me out to dinner at Earl's, a popular place in the West, and sort of a steakhouse kind of place, good atmosphere, really good meals and stuff like that. And she said, Dad, how about some oysters? And I looked at, it used to be fresh oysters on the half shell. I looked at them. I always enjoy them. But for a dozen, they wanted $40. So I thought, good grief, that's ridiculous. So I enjoyed a really, really nice dish of barbecued spare ribs, and that was still pricey. So what it is to me is that I have not been going out, and when you go out to a restaurant, even a popular restaurant, rather than, say, a high-end restaurant, the prices are amazing. But financial history shows that once the bubble is over, all asset prices go down. And also, in a boom, previous booms, you can have shortages as the prices are soaring. And then the irony of all ironies is that when you're in a contraction and a recession and weaker prices, historians have often noted that it is so odd to have hard times with plenty supply of, well, food and things like that. And I think that is ahead of us, that that the purchasing power, with a post-bubble contraction, there are going to be many unemployed, and they're just going to have to cut right down. And then with the previous higher prices, capacity to produce has been expanded. So then that's how you end up with plenty of stuff in the midst of hardship. So I think it can happen again.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be with you, and let's look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.